Lesson 11, Trading Japanese Candlesticks. Before we get started, I'd like to point out a couple things. There's a sign in the top left-hand corner called Important Information. That sign is posted on certain slides throughout this presentation. There is some very important information on the slides where this sign appears. I think you may want to take the time to really understand and even perhaps memorize the information on that page. That information can help you tremendously as you learn to trade. The second thing is there's a number in the bottom center of this slide. It's called number 2. Please match those numbers up with the numbers in your workbook. If you lose yourself, just match the two numbers up and you'll be caught up with wherever we're at. There's 16 lessons on trading the Forex that can help you in learning to trade on the Forex. These lessons are also applicable in other financial markets because they focus in on technical analysis. One of the most profound statements I've ever heard was, successful traders will do what unsuccessful traders can't and won't do. Think about it. What's the difference between you and a successful trader? You both have 2 legs, 2 arms, 2 eyes, 2 ears, a head to think, yet you'll make totally different decisions. And a successful trader will consistently make profitable and productive decisions, and an unsuccessful trader will continually make unprofitable and unproductive decisions. Why? Because successful traders will do what unsuccessful traders can't and won't do. Successful traders will take the time to properly educate themselves on how the market works. They will then create a methodology, a clear methodology and habit of how to successfully trade, and they will stay disciplined to that. They will not vacillate or deviate much from their trading plans and methodologies. To where unsuccessful traders, they will do the absolute opposite. They will be in the market trying to get lucky. They will be in the market vacillating, changing their mind a lot. They will be very undisciplined. Discipline creates success. There is a 21-day 3% rule. The human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original required information. This fact means this: if you listen to this lesson and you forget about it for 30 days, at the end of 30 days, you'll be only retaining about 3%. Our focus here at Market Traders is to help each individual trader, when it's time for them to get involved trading, to be operating at approximately 85 to 95% of the necessary information that they need to become a successful trader. By the end of this lesson, you will understand that the markets can only move up, down, or sideways. You'll learn how to read a trading chart and be introduced to the technical side of dealing with Japanese candlesticks. You'll learn that Japanese candlesticks give off buy and sell signals. You'll learn how to read and trade based on candlestick formations. You will learn how to create a trading plan when you spot a candlestick formation, and you will learn how to financially protect yourself in every trade. You will learn how to create a trading plan and trade that plan. I'd like to review reading the trading chart and placing orders before we get started. Once again, we're looking at Japanese candlesticks, which are monitoring the open, the high, the low, and the close of any time period, be it 5 minutes to a monthly chart. There are 2 types of candles. One is a bullish candle, one is a bearish candle. The bullish candle closes higher than it opens, and the bearish candle closes lower than it opens. Look at this chart. The market goes up, you'll see hollow bullish candles. The market reacts or comes down, you'll see black candles. They say the market doesn't go up and it doesn't go down. It's constantly going up and down, up and down. Be that as it may, the majority of traders watch bid charts. There is a bid and an ask when it comes time to trading, just like going to an auction. When you go to an auction, there is a bidder and there is a seller. The buyer is the bidder. The seller is asking for a certain price. The seller is offering his product for sale. That's where the terms come from. Most traders watch a bid chart, which monitors the lower of the two prices. The ask chart would look identical. It would only be 3 to 10 pips higher. Remember, we buy on the ask and we sell on the bid. Do not lose sight of this information. If this is the current price at 107.30 and we enter the market buying, we buy on the ask, which means we enter at 107.35 with a 5 pip spread. And every buy should have 2 sells. Our sell limit will be on the bid, and our sell protective stop loss order will be on the bid, which means if the market rallies up here, the ask price will hit the bid first. And if the market starts to fall, the ask price will hit this number second. The opposite will take place. If we enter the market selling, we sell on the bid. This is the bid price. We'd be filled at 107.30. We will place a protective buy stop on the ask, which means as the ask rallies, the ask will hit our protective buy stop first. Many traders think that when they short the market, when the market rallies, as long as the candle doesn't hit their stop order, they're still in. However, the ask will hit it first, potentially stop you out, and if it does fall, you'll need to check to make sure you are either stopped out or still in. But don't take it for granted because the candles did not hit it. Types of orders. There's a market order, which is an order placed at the market, whatever the bid and ask are. There's a limit order, which is placed at a certain number, and you will be filled at that number or better. And then there's a stop order, which is placed at a certain number, and you will be filled at that number, but it might be better and it might be worse, because when a stop order is hit, it turns into a market order and is subject to whatever the prices are at the market. Here's additional rules as you trade. Any order placed above the market or below the market, here's the market, that's where it's trading at right now. Any order placed above or below is called an open order, a working order, or an unfilled order. And if you place a buy order above the market, that's called a stop order. If you place a sell above the market, that's called a limit order. If you place a buy below the market, that's called a limit order. And if you place a sell below the market, that's called a stop order. Those are the rules that you will need to understand and memorize. It becomes natural as you start to trade. Another rule I believe in is that every buy should have 2 sells. Whenever you enter the market as a bull buying, you'll need to have a sell for profit and a sell for potential loss. Do not trade without a protective stop loss order. If you buy, every buy should have 2 sells, one for loss, potential loss, and one for profit. Every buy must have 2 sells. Conversely, the opposite takes place. Every sell should have 2 buys. If you're selling, you're shorting the market, your position is short, you're a bear, you'll need a buy stop for potential loss and a buy limit for potential profit. Every sell should have 2 buys. OCO means whichever order the market hits first, it will cancel the other. Whether you are buying or selling, as soon as you enter the market, you need to place a limit order for profit, a stop order for loss, and whichever the market hits first, it will cancel the opposing order to where after that order has been filled, you don't have another working order out there. Cancel and replacing becomes a great way to chase the market in an educated fashion, not a greedy fashion. I focus in on effectively canceling, replacing, and Lesson 16, trading strategies and their justification, as well as Lesson 3 on equity management. But remember, only cancel or replace to the new last low after the market has made a new high. The opposite takes place in cancel replacing as you're shorting the market. Only cancel and place to the new last high after the market has made a new low. Bulls want to buy low and sell high. They enter the market first buying and exit selling for whatever reason, whether you're trading off of indicators or any sort of methodology. Our lesson on indicators, lesson 4, trading indicators, has some great indicators to be used that help the trader know when the market is getting ready to take off and rally versus turn around and come back. But be that as it may, whether you're indicator trading or just trading out based off of candlestick formation and movement, bulls want to buy low and sell high. They buy first and sell second. Bears do the opposite. They sell first and buy second. You'll notice many times that the market comes down faster than it rallies. One of the reasons why is the markets are controlled by fear and greed. Fear is a greater emotion than greed. Because of that, prices drop faster, prices devalue faster than they rally. The great part about trading currencies is there are no special requirements in shorting the market. All you have to do is click the mouse and sell first and buy second. Even if you sell first and buy second, you are still buying low and selling high if you're going to make a profit. These indicator trades produce 350 pips in profit. One lot is $3,500. 10 lots is $35,000. Learning to trade currencies can be very profitable due to the leverage. But more importantly, technical traders learn to read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. And why do you think that is? The answer is this. People buy and sell in the market, and we are creatures of habit. And charts do nothing more than monitor our habits. Because we are creatures of habits, these charts have a tendency to repeat themselves, which then allows the average person to be able to go in, educate themselves on how these charts repeat themselves, and slowly start to predict the future. A chart is a chart is a chart. Technical analysis is applicable to all markets and anywhere you can pull up a chart. Once you've been educated on how to read a trading chart, you will start to control your financial future in the market. I'd like to review support and resistance briefly. Remember, highs have 2 candles to the left and 2 candles to the right that are lower than the wick high, and that not all highs are levels of resistance. Only higher highs that are being created become new levels of resistance from where the market is currently trading. Lows have 2 candles to the left, 2 candles to the right that are higher than either the body or the wick low, and not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. Lesson 2 focuses in on support and resistance and the financial game, but to the trained eye, you should be able to turn on a chart and be able to just scan the chart and find all your levels of resistance and all levels of support. So please understand that there is a financial game that exists. Bulls are trying to make higher highs and bears are trying to make lower lows. All protective stop loss orders must be at the last low if buying and the last high if selling. Let's look at this. For whatever reason, if we are buying here, our protective stop loss order needs to be at the last level of support. If we are selling here, our protective stop loss order needs to be at the last level of resistance. Do not trade without a stop. If the stop order is too far away from the entry point and does not meet your equity management requirements, pass on the trade and go find another trade. If you are buying here, look at how the stop order would need to be approximately 100 pips away or $1,000 at risk. Pass on the trade if the risk is too great. Now let's get started with lesson 11, trading Japanese candlesticks. Learning to trade Japanese candlesticks is probably one of my most favorite things to do, mainly because it's very simple, it's very easy, and it's easy to detect a candlestick formation. Reading Japanese candlesticks is not that difficult. Remember at the beginning of this lesson I pointed out that there were bullish candles and bearish candles, and all they were doing was monitoring the open, high, low, and close. Let's look at this again. See the bearish candles where the market is coming down and the bullish candles where the market is rallying? Well, there are several books on Japanese candlesticks that can help improve your trading. However, in all my experience, I've discovered that there's only four formations that are easy to recognize and easy to trade. When you put these Japanese candlestick formations together, they start telling a story and work on all time frames. The first one is called an engulfing candle. The second one is a morning star. Third, evening star. Fourth, doji star. And fifth, tweezer tops and tweezer bottoms. Now, engulfing candles are not what I consider to be good trading candles, and there's reasons why. I'm only going to focus in on morning stars, evening stars, tweezer tops and bottoms, and in spotting doji stars. But an evening star formation is a bearish pattern signifying a potential top. Meaning, if the market is rallying and an evening star starts to appear, that means that the market is topping out and is going to start to come back down. An evening star consists of 3 candles or more. I'm going to go into detail. But it is predominantly 2 bullish candles followed by a bearish candle. The morning star is opposite. This is a bullish pattern signifying a potential bottom. It is a bearish candle followed by 2 bullish candles. Morning stars come in many shapes and can consist of more than 3 candles. Now let's look at this chart. Here is the reason why many times in an engulfing candle, see how this one candle engulfs all these candles? Many times engulfing candles that engulf several other candles don't lend themselves to trading opportunities, because after the candle closes, it has already taken away much of the trading financial potential that is left. Now, here's a morning star. See how it has a bearish candle and a doji star candle followed by a bullish candle. Here's an evening star. 2 bullish followed by a bearish. There's the 3 candles. Here's a morning star. A bearish candle followed by what's called a spinning top and followed by a bullish candle. These 4 candles make a morning star. I'm going to go into detail about these. Tweezer tops and bottoms are, the tweezer top is a bearish pattern signifying a potential top. Tweezer tops come in many shapes and consist of more than 2 candles. Bodies can be bullish or bearish. See these down here? They can both be black, they can both be white, or they can be one black and one white. Bodies can be bullish or bearish or both, but they at least have to have long wicks. I'm going to go into the criteria here soon. The opposite takes place in a tweezer bottom. Need to have long wicks. Both of them can be bullish or bearish, but this is a bearish pattern signifying the potential bottom, which means the market is going to rally. Actually, this is a bullish pattern signifying a potential bottom, meaning the market is going to reverse. Now let's look at this tweezer bottom. Here's a tweezer top. See how you have long wicks right here? And look at how the market fell shortly after that. Here is a tweezer top. The market came up, formed a tweezer top, but it looks as though it's continuing to rally. Here is a tweezer bottom. Look at all these candles in between that signify a tweezer bottom. I'm going to go into detail about that. Now, there's several formations, and you can read about these in your book, that begin to indicate reversals. Excuse me. One is called a hammer. The other one is called a spinning top. Looks just like a spinning top. The other one is a doji star. The other one is called a dragonfly doji. The other one is a gravestone doji. And the next one is a full body candle. Put your machine on pause and read through these in this lesson. Now that I've shown you a little bit about evening stars, morning stars, doji stars, tweezer tops and bottoms, let's go through an exercise and you find candlesticks formations. Because the best way to understand what you've learned is to write down what you think you know, then go back after you've been taught and look at what you thought you knew versus what you now know. Because your perception is your reality. My perception is my reality. What we're trying to do via these lessons is to pass on our perception to you to where you can have a better education and learn how to trade. So write down what you see or think you know about Japanese candlesticks. This is a daily chart, which means each one of these candles represent a day. Put your machine on pause and see if you can find any evening stars, morning stars, tweezer tops or bottoms, doji stars, and circle them. Here's a Euro chart, 4 hours. Each one of these candles represent 4 hours in time. Put your machine on pause as you go look for evening stars, morning stars, tweezer tops or bottoms. Here's a Japanese yen 2-hour chart. Put your machine on pause as you go look for these formations. Here's a Euro daily chart. Go find morning stars, evening stars, tweezer tops, tweezer bottoms, engulfing candles. Now let's go back a little bit. Evening star formations. Remember I said this is a bearish pattern? It signifies a potential top, and that evening stars can consist of more than just 3 candles. This is an evening star. This is an evening star. It's consisting of 5 candles here. Now the opposite takes place in a morning star. This is a bullish pattern signifying a potential bottom. Morning stars come in many shapes and can consist of more than 3 candles. See how these 3 came and created a morning star? These 5 created a morning star. Now let's look at this evening star. Here it is. Here's all these candles rallying up, creating a top and creating a bearish candle equal to the left candle, of which I'm going to get into the criteria. Here's a morning star. This is a 3 candle formation. Here's a evening star. This is a 4 candle formation. 1, 2, 3, 4. Here's a morning star. This is a 1, 2, 3 candle formation. Here's another morning star. 1, 2, 3 candle formation. Here's another morning star. 1, 2, 3 candle formation. Here's a morning star. See how we have a 1, 2, 3 candle formation? See how the center candles can be doji stars or tweezer tops? Here's a doji star, morning star, 3 candle formation. I'm going to teach you how to trade these. Here's an evening star, 3 candles, 1, 2, 3. Spinning top is your center. Looks like an evening star. A spinning top. Here is an evening star which consists of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 candles constitute this whole evening star. Here is a tweezer bottom, 2 spinning tops. Here's a tweezer top, 2 spinning tops. Now, tweezer tops formations. Remember I had talked about this is a bearish pattern signifying a potential top. Tweezer tops come in many shapes and can consist of 2 or more candles. Bodies can be bullish or bearish or both, and at least 2 of them must have long wicks. Now, these are tweezer tops. See how this tweezer top consists of 1, 2, 3, 4, 5 candles, but these 2 candles, this one and this one, are of equal height and have long wicks. This is a tweezer top. See how the wick is over 60% of the candle? This does not have a body. This is a dragonfly doji. These 3 constitute a tweezer top. Look at how all of a sudden the market fell after the tweezer top formed. Here's another tweezer top. Here's a tweezer bottom. 2 spinning tops, which constitute the end of a downtrend, and look at how the market rallied afterwards. This is the end of an uptrend. Look at how the market reacted after that. These 2 look like tweezer tops. They are not tweezer tops because the wick is not 60% of the body. I'm going to be pointing that out. Now, tweezer bottoms are the opposite of tweezer tops. These are tweezer bottoms. These 1, 2, 3, 4, 5 candles constitute a tweezer bottom. These 2 candles, which really create the tweezer bottom, have long wicks and small bodies. Here we go again, tweezer top, tweezer bottom. Here's a tweezer bottom. Now, what makes this a tweezer bottom is not this candle, but this candle with a long wick, as well as this candle with a long wick. That constitutes the tweezer bottom. They're both at the same level. Then afterwards comes the rally. Now, let's trade a morning star or an evening star. Here's the criteria for trading an evening or a morning star. The evening star is a bearish pattern, and what must be taking place is as the market returns, you have 2 bullish candles, or this could even be a bearish candle here, but the market should return with a black candle or a bearish candle, depending on the color scheme in your chart. And you see, let's pretend this is a horseshoe or an upside down U. In order to trade an evening star and have the evening star meet the criteria for trading it, you take the the open of the first candle in the formation, and as the market returns, it must come back, and the third candle, or whichever candle constitutes the finish of the evening star, must return to over 60% of the U-turn. The close of the bearish candle must be beyond this point. Meaning, if this were 0 and this were 100, it would need to come back and close lower than 60%. When it's time to trade it, if it meets that criteria, what you will need to do is you will then sell or enter the market, shorting the market at the opening of the next candle with a protective loss stop order at the high of the evening star. Now let's look at this. Here's your 3 candle formation. See how the market was rallying, created a doji center star spinning top, if you will. Then it returned. Look at how the close on this bearish candle equaled somewhat the opening of the bullish candle. We then want to sell at the opening of the 4th candle with a protective stop loss order at the last high, and I'm going to teach you where to properly place that protective stop loss order if it's too tight. And look at how from entry the market just took off in our direction. Now the criteria for trading the morning star is the absolute opposite. This is a bullish pattern, meaning this is the bottom of a trend. Whenever you see a bullish morning star start to form, the market is reversing and getting ready to rally. Be that as it may, as the market is reacting, coming down, and forms that spinning top, center top, and then starts to rally, the close of the candle, which forms the U or the horseshoe, must close at 60% or greater of the U. Now let's just say this is 0 and this is 100. It must come back to a minimum of 60% and the candle must close beyond that. That becomes the criteria for trading the morning star, which means if it meets that criteria, buy at the opening of the fourth or next candle after it meets the criteria with a protective stop loss order at the last low. Now let's look at this morning star formation right here. See how the market was in a downtrend, and then all of a sudden it creates a morning star. There's your three candles. As soon as the close of the third candle formed, which is a bullish candle, we buy at the opening of the next candle, and look how it took off. I really enjoy trading morning stars and evening stars because they're kind of like no-brainers. The rules are very simple and they lend themselves to tight protective stop losses. Buy at the opening of the fourth candle or the candle that meets the criteria. Let's look at this morning star. The market is dipping or reacting. It finally forms a morning star, spinning top in the center. The market just about meets the criteria here. If it came right here at 60%, we would buy at the opening of the next candle, which might be this one or this one, depending on how you properly measured that. Now, rules to trading an evening or morning star. Find all your levels of support and resistance. Find and draw all your trend lines. Find a convergence. Hopefully you'll find a 618 trend line or an evening or morning star. Try to trade in the direction of the trend. Wait until the market bounces at that convergence. Enter the market at the market on the fourth candle or when it meets the criteria of the evening or morning star. Place your protective stop loss order approximately 5 to 10 pips above the high of the evening star or the low of the morning star. If you can't afford the potential loss, should the trade not work out, then stay out and do not trade. Pull your trader's checklist out and create a trading plan and trade that plan. Now, you've heard me use the term convergence. The term convergence means a location where there is more than one hidden, educated reason for the market to bounce. For example, a trend line, a Fibonacci number, a bell curve, a morning star, an evening star, a tweezer top. Convergences are locations that can create a bounce. Now let's face the facts. Every trader wants the market to move in their direction from entry. Watch how education on how the markets work, watch how education on evening stars, morning stars, tweezer tops can really improve our percentages. Turn on your computer software as you practice trade. We supply everyone with $50,000 worth of monopoly money that can help you learn how to hone in on your skills as a trader. Doctors operate on cadavers first before they operate on real people. You turn on your chart and this is what you see. You see the market in a clear uptrend making higher highs, but you spot a reversal. How do you know you spot a reversal? Lesson 5 that focuses in on trend lines shows you that an inner trend line has been broken. The market was waving up, making higher highs and higher lows. It's now broken a trend line and it's now making lower lows and lower highs. Therefore, we need to draw now a downward trend line. Now that we've drawn a downward trend line, our strategy is to wait until an evening star appears, because we want to trade evening stars in the direction of a downtrend, morning stars in the direction of an uptrend. Now, our protective stop loss orders must be at the last lower high if we are selling. Remember, we had talked about when we sell, we place an order at the last high. Well, if your stop order is too far away from entry point and does not meet your equity management requirements, pass on the trade. Now, let's look at here. Here's an evening star, believe it or not. But look at how after the evening star formed, because here's the criteria. Here's the bullish candle followed by another bullish candle followed by a bearish candle with a very long wick, which is the center of the evening star. Here's where it closed and returned at over 60% of the U-turn. So we would enter selling at the opening of this next candle. However, our protective stop loss order needs to go at the high of the star. But the high of that star is literally 285 pips away, which is too much risk. That's roughly a $3,000 risk if we were trading at $10 a pip. So too much risk, pass on the trade. Go look for another evening star. Trading an evening star, morning star, does offer great equity management because it allows you to trade with a tight stop. If the trade doesn't work out and you end up losing, your loss will be small. But due to the fact that candlestick formations offer great equity management trades, you may need to place your stop loss orders beyond the higher low by 5 to 10 pips to avoid being stopped out due to that bid chart. Remember, the bid chart and the ask chart, and the ask is always higher than the bid. Keep that in mind. Now, when you trade, maintain your trader's mantra, which means this: I will educate myself on how the market works. I will learn how to find and place a trade. I will trade with equity management. I will never trade without a protective stop loss. I will not chase the market. I will be patient. And if the market does not meet the criteria of my trade, I will not trade. Now, here we are. This, because we do our trend line, this lends itself to great equity management. We now watch the market hit that trend line. Lesson 5 tells us that the market bounces as it hits trend lines. We're going to anticipate a bounce, but you can almost see the evening star starting to form. Look at how you had bullish candles followed now by a bearish spinning top. Now all we need is another bearish candle. We now have the criteria of the evening star as long as it comes down to at least 60% of this candle right here. We've marked all our levels of resistance. Here's all our levels of support. The game that's being played is this. The bears, if they maintain control here, and if this evening star works out, the bears will go achieve new lows. They will take out or make new lows. These are the latest new lows or levels of support. The financial game is about the bears maintaining control, reversing this chart around, and establishing all new lows. The evening star forms at the trend line convergence. The reason we call it a convergence is because convergences are located where locations where the market should bounce. Now can you see the evening star? There it is. 1, 2, 3. With the formation of the evening star, we are then going to sell at the opening of the next candle, which is right there. We will sell right at opening. Our protective stop loss order will go about 5 to 10 pips above that high, giving the market room to to vibrate because it moves and swings as it starts to fall. Fill out your paperwork. Fill out the date you're trading. You want to maintain a paper track record of everything you do, just in case your actual trading software fails, your electricity goes out for whatever reason. You have written down everything that you're doing, make a habit of it, and keep it in your book. It's great for references. Now, we sell right at the opening of this next candle, which is the fourth candle. We put a buy protective stop loss a little beyond that high and a buy limit order for profit somewhere down here. All those lessons on Fibonacci trading and support and resistance will participate in helping you learn where to properly place your order to get out for profit. The evening star forms at the trend line convergence, and we enter the market at the market on the fourth candle. And look at how right at the fourth candle the market just fell. We're talking some serious money here. And this is, you're able to short the market. Look at how the market came and took out all your previous lows. The financial game comes into place. Your trading software will monitor your P&L statement, but fill out your P&L statement on your trading form. Keep up with what you're doing. Now, let's trade a tweezer bottom or a tweezer top. Once again, here's the criteria for tweezer top formations. There must be at least 2 candles of equal height. See these 5 candles? There's 2. To where the wicks must be 60% of the candle. See how the wick is over 60% of the candle here, and here you barely have any body of the candle. See, so there must be at least 2 candles of equal height and long wicks. Spinning tops, doji stars can consist or make up your tweezer top or bottom, and the wick must be over 60% of the candle. Let's look at this. The rule for trading the tweezer top formation is this: sell at the market on the formation of the third candle or whichever candle meets the criteria of the tweezer top or bottom with a protective stop loss order at the last high, which means once you spot a tweezer top, sell at the opening of the next candle with a protective stop loss order at the last high. If the protective stop loss order is too close, you may want to go beyond it by 5 or 10 pips. Criteria is the same for a tweezer bottom. Equal wicks. The wicks must be over 60% of the candle. The criteria or the rule for trading the tweezer bottom formation is this: buy at the opening of the next candle as long as the wick is at least 60%. Look at how this one is approximately 80%, with a protective stop loss order at the last low. Rules to trading a tweezer bottom are this: find all your support and resistance levels, find and draw your trend lines, find a convergence that can participate in helping you out. A 618, a trend line, a tweezer top or bottom, or excuse me, a tweezer top or bottom. Try to trade in the direction of the trend. Wait until the market bounces at the convergence. Enter the market at the market when the tweezer top or bottom meets the criteria of your trade. Place your stop orders approximately 5 to 10 pips above the high or the low if it is a tight tweezer top or bottom. If you can't afford the potential loss on the trade, should it not work out, then don't trade. Pull out your trader's checklist and create a trading plan and trade that plan. Now, you heard me speak of convergence again. Once again, it's a location where there is more than one hidden, educated reason for the market to bounce at a trend line, a fib number, an evening star, a morning star, tweezer top or bottom. That's a convergence. Trading tweezer tops and bottoms offers a great equity management trade, once again with a tight stop, because if the trade doesn't work out, your losses are small. Here's that important sign again. Please, please, please memorize this. Due to the fact that trading candlestick formations offer great equity management, you may need to place your stop loss orders beyond the high or the low to avoid being stopped out because of the bid chart. Once again, turn on your trading software. Here we see the market in an uptrend, making higher highs and higher lows. We've already experienced some profit from this tweezer top, and we start to see another tweezer top starting to form. When tweezer tops start to form, doji stars, evening stars, spinning tops, it signifies that the market is exhausting itself. We then sit and wait, and all of a sudden another spinning top appears, which constitutes two spinning tops side by side, which meet the criteria of a tweezer top. We now enter the market selling at the opening of the next candle with a protective stop loss order at the last high. Look at how if we enter selling here, our stop will be like 20 or 30 pips away. You may want to go 25 or 35 pips. Put additional 5 pips in there, 5 to 7 pips, to avoid being stopped out early. Fill out your paperwork. Now, look at what happened when we entered at the opening of the next candle with a protective stop loss order. Look at how this trade went our way right from the beginning. That's what I really enjoy about trading tweezer tops, tweezer bottoms, evening stars, or morning stars. The trades predominantly go your way from the beginning. Just like this tweezer top, look at how we entered right at the opening here. Look at how it came our way right from opening. Here's a nice tweezer bottom. We buy at this opening of this next candle. Look how it went our way from opening. Fill out your paperwork. Print out the chart on the top half of this sheet so that you can go back and refer to what you've done. Remember, at the beginning of this lesson, we asked and stated the best way for you to understand what you've learned is to write down what you think you know, then go back after what you've been taught and look at what you thought you knew versus what you now know. Your perception's your reality. Put this on pause. Go look up and see what you wrote and circled on evening stars, morning stars, doji stars, and engulfing candles. Here was the first chart. Did you see all this? Here was the second chart. Did you see all these evening stars and morning stars? Here was the third chart. This is Japanese yen 2-hour chart. Did you see all these evening stars, tweezer tops and bottoms? Did you know that an evening star can consist of what? 10 candles? Did you know that tweezer tops can have candles in between? Here's a daily chart. Did you see all these tweezer tops and bottoms? Did you see all these morning stars and evening stars? Did you circle this one? A lot of people think that this is a tweezer top. Could meet the criteria of it, but the problem that I have with it is that wick is not over 60% of the body of that candle. Be careful, you'll get burned more on these than you'll ever get paid off. Now, do not trade an evening star or a morning star in any sort of consolidation. Lesson 9 focuses in on consolidation, sideways movement, bracketing. You will see in consolidation and sideways movement and bracketing a lot of doji stars, evening stars, morning stars. There's a reason why they are forming. Stay out of trading evening stars, morning stars, tweezer tops and bottoms in consolidation. If the candlestick formation does not meet the criteria, then don't trade it. If it is not clear visually, don't trade it. If the protective stop is too far away, don't trade it. And when in doubt, stay out. Once again, the term convergence Go look for evening stars, morning stars, tweezer tops and bottoms in the direction of a trend at a level where it lines up with a Fibonacci number, a trend line, i.e. support becoming resistance. Try to find them at a criteria. Once again, make sure your evening star meets the criteria before you enter selling at the opening of the next candle, which is it must return to over 60% of the evening star formation. Same with the morning star. Make sure it meets the criteria, meaning it must return in its formation to over 60% and have a closed candle before you go buying at the opening and placing your protective stop losses at the last low. Tweezer top formations, make sure they meet the criteria. Tweezer bottoms, make sure they meet the criteria before you enter the market at the opening of the next trade. Trade in the direction of the trend. Please keep in mind, I'm going to repeat this one more time, due to the fact that trading candlestick formations offer great equity management trades, they also allow for very tight stops, which is good. But sometimes if it's too tight and you place your order at the last higher low because of the bid chart, you could get stopped out prematurely. Here once again are the rules to trading an evening star and morning star. Read them, memorize them, understand them. Here's the rules to trading tweezer tops and bottoms. Read them, memorize them, understand them. Know what you're doing. Now, did this lesson teach you how to read a trading chart and be introduced to the technical side of dealing with Japanese candlesticks? Did this lesson teach you that Japanese candlesticks give off great buy and sell signals with tight stops? Did this lesson teach you how to find a trade based on a candlestick formation and how to create a trading plan when you spot a candlestick formation? Did this lesson teach you that trading with stops helps you as you create a trading plan and that you need to financially protect yourself in every trade? If this lesson did not teach you these things, go back and play this lesson, because 90% of all novice traders fail. And this is a zero-sum game where losers pay winners. You become one of the winners. You become that 10% that succeeds. You become one of those successful traders who will do what unsuccessful traders won't do. Because there's only two ways to pay for your education. One is to become lucky. And I have learned that if you're looking to trade in the markets just to become lucky, it'll only be a matter of time that you will become unlucky because you don't know what you're doing. And the saddest part about becoming unlucky in the market is this. If you become lucky and then it's only a matter of time that you became unlucky, you do not have the education on how to earn your money back. Which brings up the second way why you need to properly educate yourself in the market. Mentorship is the second way. Working with a mentor and getting the proper education on how the market works can improve your percentages dramatically. Market Traders Institute and ForexTips.com, we are mentors. We are coaches. We teach people how to trade. We take experienced traders to higher levels of achievement. That's what we do. And learning from a mentor is like buying a map to a gold mine. If I said, hey, there's gold in them there hills, there's two ways to go about getting that gold over there. One is you could go over to that mountain and spend how long? A week, a month, a year, 10 years trying to find a vein that leads into the mother lode? How long could you last? The more educated and prudent way would be to buy a map, so that map could point you in the right direction how to extract gold from those mountains. Well, I will tell you, these charts many times look like mountains, and I will tell you that there is gold in them there hills. There is money to be made trading in the market, but consistent money is made from educated traders. We all want the market to move in our direction from entry, education on how the market works, improves those percentages. Look how I showed you a simple little trick, if you will, in understanding evening stars and morning stars, how it pays off dramatically. There's 16 lessons in this sequence that can teach you on how to very profitably trade and understand how the markets work. They're there to help you. They come each lesson with trading exercises that allows you to trade. We have trading software that allows you to trade with pretend money before you open up your account with real money. It teaches you how to buy in to a trader's mantra, which means after you properly educate yourself, you'll be patient and wait till the market meets the criteria of your education and trading methodology, or you will not trade. And remember, if the chart is not clear and does not visually make sense, when in doubt, stay out. As a reminder, the 21-day 3% rule, because the human mind forgets 80% of everything it learns within 3 days. Please replay this over and over and over again until you understand it, because if you don't use it, you lose it. And on behalf of everyone here at Market Traders Institute Incorporated and ForexTips.com, on behalf of your family, on behalf of your financial portfolio, on behalf of your hard-earned money that you have saved, we all thank you for investing in yourself and properly educating yourself how to trade before you trade.